too eager to get into the trade. And another thing that I often talk about is refining the London kill zone in itself. So this is the question that probably most of traders are asking at some point in their trading journey. Why I'm losing so often, what is wrong with me, and so on. Losing streaks actually are a pretty normal thing, especially if you've done all your due diligence, if you backtested your strategy, if you know your system inside out and you've been adjusting and refining your system for quite some time. This is of course something that you must keep in mind, that then you, let's say, have a 50% strike rate. It doesn't mean that you are going to win one trade, lose one trade, win one trade, lose one trade. There's absolutely everything wrong with this type of thinking, because trust me, when you realize how actually trading works and how actually probabilities work, it will be an absolute game changer. A lot of traders, after losing one trade or two trades, think that their system is broken, that they must change something about it. But now what happens when you, let's say, backtest 100 of trades, you built your system, and then after losing a couple trades or three or even 5 or 4 trades, you decide to change something. Now you completely flipped over everything that you just backtested, and all the data that you had while live trading, backtesting and stuff like that is absolutely skewed, unless of course you go through all of those trades that you backtested and you apply the same rule that you want to implement. Please don't jump into your strategy and don't start mixing things up. With this video, I'm not trying to make you change parts and stuff like that. I'm just trying to help you understand how probabilities work. I'm trying to help you understand how technicals work from my side, what I look for, what I avoid, and stuff like that. So that hopefully after watching this video, your strike rate increases. But please don't do it blindly. Go and apply that same rule if you put it into your training plan after this video. Go through all of the trades that you took before and see if it actually makes a difference or not. So the first one, being aware of those times in the day when the volume is lower, not fully trusting the structures, because more often than not, they become traps or just liquidity that price will sweep later. This vertical line right here shows the New York midnight open. So let's now quickly draw the London kill zone. So what we have here, notice that if we take this and we make it a vertical line, what we have right here is from New York midnight open to 2 a.m. And again, we are operating on the New York time zone right here. So this window is something that I talk about often. This is where tons of fake structures take place, tons of structures that sometimes look convincing, but they end up not working. And there's a very clear reason for that, because this window usually is just generating and accumulating liquidity. And when price moves into the London kill zone and actual volume begins, this is when all of this liquidity gets swept and the actual move into your direction takes place. So let me show you this example. And by the way, we are talking about today's price action, not like we are digging into some old past data or something like that. We're literally talking about today's price action. Today is 17th of Jan that I'm filming this video right here. And what we have on your dollar 2-minute time frame, notice this price dips lower. This gray box right here is Asia range. So let's say your strategy is waiting for protraction below the Asia range, trading with the lower time frame development and stuff like that. So let's say price ran this Asia range lower here, and then it runs more liquidity. And after that, you see the price, let's say, dips into some PD array. Let's say we have some PD array from the left right there. And after that, what you do, you pay attention to this high. Now thinking that if price breaks above this high, you have a change in delivery, and from there, let's say you start focusing on bullish PD arrays. So taking the Fibonacci tool from the low to the high right here, what we have is our minute dealing range. Let's say you focus on the discount. The first fair value gap that you have in the discount area is this tiny bullish fair value gap right here. And let's say you start looking for an entry, targeting Asia range highs, for example. And this is what ends up happening. You are simply waiting for the smart money concept type of reversal, price running liquidity, interposing P array, giving shift and delivery. And after that, once price drives into the discount area, you start looking for entries, expecting for price to continue towards your target. But what ends up happening, you are not wrong with your analysis. You are simply wrong with your timing, because that exact same thing worked out during the long on kill zone. What price did, it ended up taking out this sell side liquidity again. Then notice how price keeps on building liquidity right here. And right after 2 a.m., when the long kill zone started, notice how the real volume begins, and price with momentum starts rushing and pushing lower right here and forms this exact structure, running sell side liquidity deeper into bullish P arrays on the left. Then it takes out this high. We obviously don't go blindly into this trade. We wait for price to build some more. Right here we have E1, so expansion 1, then we have expansion 2, and right here this will have then a pretty neat entry for you to enter your position, especially if you're expecting for a PO3 classic buy date to take place, looking for long bond kill zone low of the day, near kill zone continuation. So obviously we are not talking about the full context of this position. We are not talking about the higher time frames, lower time frames, and all of that. We are strictly talking about this small piece of the puzzle that a lot of traders miss, and they are just too eager to get into the trade. And another thing that I often talk about is refining the London kill zone in itself. The early window for the London kill zone is from 3 a.m. to 4 a.m. This is usually where the key structures form. So what I'm talking about is that in the first half of the London kill zone, pretty often we still get some fake structures. So price quite a lot of the times are just consolidating all the way till the early window. Then it leaves a strong structure and starts pushing away. In this case, you can see that the E2 happened during early window. So this would have been still a pretty great trade because we already had first signs of bullish order flow right here. Price rejecting this fair value gap. Then it took out this high. It pulls back again to this bullish order block overlapping bullish fair value gap and continues. So that is that regarding this situation. Be aware of time of the day. Be aware of the volume. Even when the structure, like in this case, is looking very neat and clear, don't blindly trust these times of the days. And regarding the early window, during the long on kill zone, it's from 3 a.m. to 4 a.m. And what comes to me or till zone, our reversal time is from 8 a.m. till 9 a.m. And again, we are talking about the New York time zone. You can change it right here on the bottom right. Now, another thing that I want to talk about is being aware of the lower resistance liquidity, even when the direction seems to be clear, even when the overall PD rays are looking pretty nice and clear. Please don't blindly trust formations that happen near low resistance liquidity. And by low resistance liquidity, if we are talking about the buy side, this is when price is forming these close ramp formation type of lower highs right here. So a good example would be, let's say, this area right here. Notice how every candle is opening lower, lower, lower. This round area is a low resistance buy side liquidity area. Vice versa, what comes to the sell side liquidity, this is when we have these small higher lows right here, one close to each other, giving this trend line-ish round formation. Also, of course, all of the equal highs as well as the equal lows, these are liquidity pools as well that you want to pay attention to. So let's imagine now that after this low formed right here, you saw price reject this bullish fair value gap and it starts rallying higher. So now another thing is that, let's say once it gets here, you have your target, your main target, let's say right here. If this is your main target for the day, and you see price run all the way toward this area, but then you start asking yourself, which bidder race should I trust? Because in this area right here, in this expansion from this low to this high right here, what we have quite a lot of bullish fair value gaps and stuff like that. You never want to focus on PD race in the first half right here, when you have low resistance hanging right below, because more often than not, you will get stopped out before the price actually will run. So in this case, let's say if you focused on this fair value gap, what ends up happening when price dips lower right here, and let's say you entered on the high of this fair value gap, placing your stop loss below this low, aiming for your main target right here, let's say. Again, this is just an example, of course. Notice how price drives lower, then it rallies higher, trapping even more long buyers, and drops lower again. In this case, stopping you out completely before it runs to the upside. By this point, if you are already at breakeven and stuff like that, this is of course okay. But when you're looking to enter and below you have low resistance liquidity hanging, like in this case, we have these equal lows right here, this perfect equal lows. Price will more often than not completely gravitate and take you out before it will actually go towards your target. So even though we have, let's say, this BPR right here, balanced price range, can price give a bullish reaction from this area, notice how it came back again and ended up taking out fully this low resistance sell-side liquidity before it eventually rallied higher again. So there are a million examples of how to approach this type of situations. The same way why you wouldn't want to go short, let's say right here, if you have these equal highs right above. Again, we are not talking about full context. I'm talking about this specific, let's say, situation. You have your target somewhere lower and you try to go short in this type of situation. Trust me, you will get taken out more often than not. And be careful with situations like that, because it's great that in this situation price was aiming for these equal lows right here. That more often than not, if you have, let's say, a target right here, and I'm talking about a bigger target, price will eventually take you out before it will drop towards that target. And this is where you want to be in your position right here. Sharp momentum-driven developments, trading away from sharp highs, sharp structures, not trading away from ramp formation and liquidity pools. Now, another thing that you want to be super careful of is traps. And what I'm talking about, when we have a one-sided direction and price moving towards a bigger target, when a price from the bigger perspective is rejecting bullish PD rays, very often it will give you, if you're, let's say again, moving in a bullish delivery, it will give you these trap formations that a lot of traders will confuse as a market shift structure break to the downside. But in reality, what happens right here is that price runs buy side liquidity, sell side liquidity into bullish PD ray. More often than not, this PD ray right here will be fair value gap. And price will continue running higher, seeking for buy side liquidity and this bigger target that's above, trading with the main direction. And now what I'm talking about more specifically in this, let's say, situation, some traders, even on a lower time frame, let's say if it would be on 1 minute time frame, that would be even more clear. They see price drop lower right here, taking out this low. Then they see all of this bearish imbalance, then think that price is now about to pull back and give a continuation to the downside. But they are completely ignoring the bigger vision. Notice that price right here formed a low. Then it left another struggle right here running sell side liquidity. Bullish order flow is back in control. Price respecting bullish Peter race, rushing to the upside, seeking for buy side liquidity. It takes out these equal heights right here as well. And then after running some buy side liquidity, what price usually does is it gives a reaction. And when that happens, a lot of traders completely lose track of what's the bigger target. So in this case, obviously the nearest target buy side liquidity pool was right here, which was tagged to absolute perfection right here. But this is there a lot of traders, I'm pretty sure, took quite a lot of losses, seeing price take out this low to the downside and start giving bearish reactions away from this bearish imbalance right here, obviously placing their stops above this height, aiming for the low, let's say. So in this way, they are simply blowing against the wind, and this is not where you want to end up. You want to zoom out, realize where is the bigger or the flow going and drawing towards, and realize that all that this is just a simple shakeout. This is a simple liquidity shakeout, trap. There are many names that you could call this type of situations, but overall what happened here, price ran buy side liquidity, it ran sell side liquidity. This wasn't a break of structure. This was just a sell side liquidity run. Then it ran into this bullish fair value gap, and what it did, it expanded to the upside again towards the main target right here. So if you see price pushing back into imbalance right here after taking out this low, be very, very careful and very, very suspicious about this whole price action. And ideally, if you still, let's say, have everything on your side and your main target for the day is lower right here, but price is giving this very trappy type of price action, at least wait for first signs of order flow to kick in first. And what I'm talking about is for price going higher towards the bearish pedigree, rejecting it, taking out this low right here. Ideally, you want this high to run into the premium of this. You create a dealing range, and if price takes out this low right here, this is when you can start looking for a potential short opportunity right here, but not with the first one. Also, make sure that these drops right here, these deliveries to the downside, are actually sharp and every one-sided, especially when it comes to the second one. So this is how you can go around in some cases from not getting trapped into this type of formation. But again, when price is taking out a specific structure right into imbalance, be very suspicious and be careful of potential traps. All right, so now another thing that you must be careful of is trading before high impact news. And I'm talking about unemployment rate, dollar PPI, CPI, FOMC, NFP, and all of that. These high impact news very often at least 2-3 hours before the announcement take place. The overall price action is being pressed into range. So in other words, price action right here, candles are just marking time. They're moving without intention, and price is just simply accumulating liquidity that will get spiked out with the red folder news. So this is when you don't want to be trading, because all of these formations are pretty much the same of what we just talked about when trading in that window between near midnight open to the start of the long run kill zone. So this is just a great representation of that. Notice how price was just building liquidity all the way from here. Tons of low resistance buy side liquidity. Then before the news, because right here we are talking about again 14th of Jan, Tuesday, we are at 8:30 a.m. We had USD PPI. So notice how even this whole formation was just a sideways consolidation as well. And with the announcement, what price did, it spiked higher really fast, taking out both this high right here and this high right here. It's very strange that it didn't end up spiking out the low and sell side liquidity right here, because pretty often what price does, it's building liquidity and then it spikes out both sides before picking a proper direction. So this is where the news happened, and price before that is just accumulating liquidity. So if you are trading inside of this range right here or right here, you will get chopped out of your positions more often than not. So be aware of that. And there's a reason I'm not trading FOMC at all. I'm not trading the whole FOMC day, because usually price is just consolidating and accumulating liquidity the whole day before the announcement. FOMC statement happens at 2 p.m. So yeah, I'm not trading at all during that day. And what comes to MFP, I'm not trading the whole Thursday and Friday of that week, because usually after the first half of Thursday, price starts doing this exact same thing and it continues all the way till the NFP, and then it takes direction. So what we want to focus on is the next week after this whole mess right here is out of the way. And here, of course, we are talking about bigger perspective, not some 5-minute price action and stuff like that. We are talking about 2 whole days consolidating before price takes out all sides and then starts running. So next week when we open, we have all of this out of our way, all of this destructive behavior from price action, and from there we can focus on what actually matters. So that is all with this video. I don't want it to turn into some 30-minute type of lecture and stuff like that. In this one, we actually only scratched the surface, and there are so many more pieces of the puzzle that you need to pay attention to on your charts and then your trading, but we will talk about them later. That is all. Hope you took away some value, and we will talk very soon.